Hello and welcome to the Investor Master Series. My name is James Boyd. Today's Tuesday morning. I'm in Salt Lake City. Behind me is some white powder. A couple inches of snow. Barb actually lives on the east side of Salt Lake City. She probably has about a foot of snow. So Barb, keep it where you are. Welcome, Barb. Welcome, Will, Brown Buffalo, Barat, Josh Pink, and many others. Good morning to all. Let's go ahead and get started. Now, this topic, this series, that's live and recorded. Remember, this is Investor Master Series where we talk about stocks, technical analysis, fundamentals, options. We try to bring it all together. We won't talk about futures, currency, or anything like that. We will not talk about ETFs. If you want to join us on Friday, Kevin, Taco, Horner, and myself, we actually talk ETFs Friday morning at 9:30 a.m. Eastern. Join us. Now, just real quick, so we'll talk about stocks, technicals, fundamentals, options, okay? And the goal is to bring it here together. Now, remember when we actually get started, remember when we talk about stocks and sometimes options, remember that options carry a high level of risk and are not suitable for all investors. The information provided here is for general informational purposes only. We'll talk about pros and cons of strategies, reward and risk also as well. Remember that investing involves risk, including loss of principal. So really with every trade, even though it might look like an unbelievable setup, it doesn't matter. There's risk with it. And also when we get going, remember if we talk about short options like selling a call or selling the put, those short options and obligation can be assigned at any time up to the expiration regardless of the money amount. That's called American style options, and that's what we trade, okay, in our examples. So just be aware of that, of what is the obligation, what can happen prior to expiration and at expiration. Now, also here today, we want to really talk about market conditions, want to talk about a potential higher low in the current market that we have already, want to also go back to the oscillator that we've been watching really in the last 2 weeks as far as the stochastics. Also want to talk about kind of some new examples and past examples. Our new examples are going to be kind of not in just one or two sectors. They're kind of all over the place. Want to, though, carry that theme of what we've really been talking about the last 2 weeks or so. And this is our playlist from our class. Feel free to bookmark this. So if you said, well, I have intended, or what did we talk about before? Well, last week we really talked about understanding delta, okay? Why is using options and stocks in combination? Why do people do that? We talked about that understanding delta and kind of thought that maybe some people might need a little reference to that. And many of you enjoyed that and had questions on it. I will talk about that a little bit more today as a quick reminder. We also talked about the previous week, why married puts and collars. Previous week before that, exits and option protection. Option volume and implied volatility with trends, cash secured puts with protection. So you can kind of see in the last 5 weeks or so, a lot has been discussed on protection, okay? And now, by the way, that doesn't necessarily mean that we won't talk about that, but you should be getting some practice on those topics, okay? Now, what I want to do is let's go just real quick to the charts. Let's pull up the SPX just briefly. Now, if I pull up the SPX, and here we are, I want to kind of zoom into what we actually see. Now, in the last, let's say, I don't know, since February 21st, we had not had any green line on the 10-period moving average to save our life, okay? The only time we had a green moving average is when we drew a green line on the moving average to see what it could potentially look like, but it wasn't there. But it was really on Friday, okay? Friday, we actually had the 10-period moving average go green right there. There's Monday. We had not had a crossover. Oh, okay, couldn't even believe it. Oh my gosh, a bullish crossover. And then we had finally had the 10-period moving average go green and the crossover. And then today we get a red candle. And I'm going to say something right here, and I want you to kind of tell me, do you agree or disagree? The breakout was a failed breakout. Is that really how we would look at that? Or would you say something if you were teaching this class, knowing what you know, what would you say? If it pulls back down like it is today, is that a failed breakout? Now remember, and I'm going to say it again, when you get a diagonal breakout or a horizontal breakout, it doesn't matter. when you actually get that diagonal horizontal breakout, if we said this was the first day of the breakout, okay, and for example, we actually had the second day yesterday, the second day, if you go back and study breakouts, horizontal or diagonal, the second day actually tends to be the day where you make a what? What do we actually always say? The second day tends to be the higher, help me out here, the higher high. Now, this move, and this move is interesting, but really where it becomes potentially even more interesting is if you can get the pullback that stays above the moving average. Now, if we said to ourselves, what moving average would we like to stay above? Of course, we would say the 10, okay? Second moving average we'd like it to stay above clearly is the 20-period moving average. That 20-period moving average is pretty much where the breakout occurred, and that's going to be the marker of 55.58. So we don't care if it's a red candle. We want it to stay above the shorter-term moving average, which is at 55.85, and worst case is stay above 55.58, which is where the breakout occurred. Now, when we talk about the stochastics, we've been pasted in this oversold territory for a while now, and we've now started to stick our nose out of that oversold area, okay? So, better price action on the SPX. We're in the prop. We made a higher high yesterday, and remember, when you make higher lows, they don't have to pull back for a week, 2, 3 weeks. They could just pull back for 1, 2, 3 days and then try to get a bounce. So all eyes are on the numbers, the levels that I just gave you, okay, and that you saw as well. Now, when we look at the Dow Jones, you're going to notice the same price action there. And if we looked at that and said, well, where do we want it to hold? Well, where was the kind of the breakout, right? Right about right there, the Friday action. You're going to see right where's the moving average. Those are the markers. Do not fall hook, line, and sinker, okay, on, oh, the color of the candle's red, and therefore it's a failed breakout. Remember, higher highs, higher lows. So when you make a higher high and you make a higher low, what does that look like on the chart? Red candles, okay? You run up in price, get to a higher high, and when you pull back, what does the pullback look like? Red candles, okay? We don't care about the red candles per se. We want to know, does the red candle stay above the support levels? And if you go back on that, the stochastics trying to come out of that oversold. So there's some better price action here. Volatility, if we go look at just real quick, the VIX. We said on this, and I posted probably 3 to 4 times as an example, not a recommendation, okay? On X, I mentioned if the VIX got below about 25, that would be more of a potential bullish setup for the market or some bounces on some stocks, as we'll see here in just a sec. So far, we actually broke down below the 25 on the 12th. We made a lower low yesterday. When you make a lower low and you make a lower high, what does it look like? You get green color candles. Clearly, we want the price to stay above the 10-period moving average. Worst case, we want it to stay below 25, okay? And that 25 is going to coincide with the 20-period moving average. Remember, falling volatility is a bullish investor's friend, okay? Don't forget that. Now, some things that I want to kind of bring up, I cannot show you the gold chart. So I want you to imagine, I'm going to draw you what the gold chart might look like, okay? And if we looked at and kind of said, hey, we talked about this last Friday, so I'm going to draw you what the gold chart looked like. The gold chart kind of looked like it fell down, ran back up, kind of chop, 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 chop. Gold overnight, that's kind of what it looks like. Gold overnight hit 30.34. I know, it's kind of funny, isn't it? I'm laughing too. Now, the biggest actually thing is, so that's the gold price. Interesting thing about gold price is when you actually go out and look kind of in the future, those prices are actually higher. So the trend is still in gold, the price of gold. We'll go look at a gold company in just a second. Now, it's not just gold. We talked about on Thursday and Friday. Copper has also been quite strong. But I also want to kind of show you a picture, let's say, silver. Silver is kind of like sideways action. And then I want us to kind of keep an eye on silver. I'm going to pull up a couple silver stocks here in just a moment. But silver kind of looks like, just imagine this chart with silver. I know, laugh with me, okay? silver chart. Imagine this is silver, and it kind of looks like it keeps spending a lot of time at resistance, okay? And so the other one we're going to kind of keep our eye on is silver. Could it kind of mimic what's happening with gold? But we call this the precious metal sector, okay? So when you look at gold, you look at silver, you look at copper, and so on, it's kind of interesting to kind of see that those are almost like becoming staples for some people that actually are saying, look, there's some volatility, there's some fear, etc. I want to kind of be in some things that are maybe not as correlated to the stock market. Did you guys like my drawings? I thought it was pretty good. Okay, now let's kind of talk about, speaking of some of those gold stocks, let's go back to AEM for just a moment. Now, if I look at AEM, okay, this is the one we actually talked about last Wednesday in the fundamental class on Wednesday at 4 p.m. Eastern. And we actually were kind of looking to see if we could get a little breakout to the upside. And it's gone up, went down for a day, bounced back up again, and then today, doink, hit a brand new high. I mean, I don't have a whole lot to say on this besides we're not at the target yet of 114-ish and change. That stock position, if we go back and look at it in the paper money account, it's 129 shares of stock, up about $3 or so, up a couple bucks, about $400. As the investor would say, I always need more. That's probably what they're saying. Now, if we went back and said, is there any other gold stocks that might be kind of getting a little move here? That's an open question for you. Now, as I'm getting an answer, I'm going to go back to just real quick scan, okay? And what I'm going to do is I'm going to go scan, and I'm going to go scan in, and I'm going to go down to the sector. Now, we know that gold or silver stocks, it's not in technology. We know it's not in discretionary, okay? We know it's in materials. And if we go to those materials, what we're now going to see is if we go to all materials, there she is, okay, metals and mining. Now, when we do this, what you're now going to see is aluminum, okay, copper, okay, gold, precious metals and minerals, silver. Now, if you don't mind, I'm going to go select all metals and mining. Now, I'm not really trying to nail something perfect, get one or two stocks. Just give me a stock, and we always use these filters. Just give me a stock $40 or higher. Okay. Now, in the space of, let's say, precious metals, there might be some stocks lower than that. So I'm going to take $20 or higher. Okay. Now, you got to remember is when we look at the volume, this is the volume so far today. So here, if we're into the market, let's say 90 minutes, this is saying that the volume currently, not average volume, the volume currently is 500,000. And if I say scan, how many stocks do I get back that are priced above $20 that actually have a current volume of 500,000? And then here we get the list. Now, if you don't mind, what I'm going to do is I'm going to go over here to the right-hand side, click on the three lines. Why? Well, because what we're going to do is we're going to make a watch list out of that. Save as a watch list, click. And now what I'm going to do is I'm just going to say class, I'm going to label the date, 3/18, okay? So all I did is I clicked on the three lines, okay? Going to make a watch list, save. Now, we're going to go back to Market Watch and hit quotes, okay? Now, but where's the list? Well, remember, to pull up your list, we're going to hit the drop down right there, and we're going to go to personal, and what you're now going to see is a personal list that we just made. And there it is, class 318. So what it does is it's going to go through the filter of actually looking at things like price performance, 1 week, 1 month, year to date, and so on, volatility, and it's also going to tell us the type of trends. Now, my gosh, I mean, where's my glasses? Okay, because what we're seeing on this chart is holy dadgum St. Patrick's Day. Okay, lots of trend 2s and 3s. What you also notice is in the relative strength columns, it's looking at the stock performance in different durations of time, comparing its performance compared to the S&P 500. And there's a lot of green there. Now, this is the disclosure, okay? When we talk about scripts, okay, and here we are on the 14 minute and 52 second, I just want to make sure there's no misunderstandings. Scripts are not guaranteed for accuracy. You should also, and they're not guaranteed for timing. If you use any script, you should have a sound understanding, foundational understanding of what is it trying to look at. Feel free, and also have an understanding is, can you verify it? Feel free to join Michael Fairborn's class Friday afternoon on scripts to get more of an understanding of how scripts work and how they could be helpful, and also just getting some interpretation of them, okay? That way you can verify, okay? That was my disclosure. Okay, good. Now, you're also going to notice that in here, there's quite a few holds and some highs. I want to go back to, now, by the way, there's AEM right there. Is there any other stock in here that we might take a quick peeky at? Well, let me go over here just real quick, click on the 3 lines. Let me just go detach, okay? Now, what I'm going to do is I'm going to click on that little chain right there, and I'm going to click 1. So when I look at this, if I click on, just go to the chain, click 1, what that's going to do is when I go back to the charts, okay, and it already has 1 linked right there, when I click on that list, AGI, okay, Alamos Gold, pretty strong uptrend, okay, there's one, another one. If I go back and look at, let's say, AU, that is actually kind of an interesting pattern right there. We could even say that maybe that was like a little W pattern, perhaps, or you might say, James, I kind of see it more like a V, and we see that a gap to the upside today with the old resistance area here. Now, I'm going to give you an in-class quiz. I'm going to ask you a question, and I'm going to act like I asked you the question of as follows. I want to buy the shares and consider buying the put. How would I do that? Okay, so tell me what I should actually click on. Where do I go? Where do I check? Is it something that we would consider? Okay, now, first off, before I even open up the option table, we actually see that the volume so far on AU, this is so far 1.2 million in the first about 90 minutes of the market. Now, the second thing that we would actually probably look at is what? Level 2 trading? No. Beta? Maybe. Okay. Really, what I'm looking at out of the corner of my eye is really that implied volatility. Why do we want to know about implied volatility? Well, because the higher the implied volatility, the higher the puts. Okay. And that's going to affect how much the stock has to go up to break even at expiration. Now, when we actually look down about, let's say, 40-ish or so days to expiration, typically the monthly options, we're going to pull up the 17 Aprils. Now, if we had 1.2 million in terms of shares, there's probably a pretty decent chance that if the stock volume is there, the option volume, there might be something traded, okay? Now, if we go down and look at the money strike, stock's at 34. So if we go look at the calls and we go look at the puts, we see the bid-ask spread right here is 10 cents wide, open interest 837. If we go look at the put side, about 34, 60 contracts total. And what you're now going to notice is the strike here of 34. Now, if we go take a look at this, do you notice anything that kind of stands out? Anything? Well, first off, those seem a little high, okay? Now, what was the percent that we were kind of trying to take a look at to stay below? Now, the investor doesn't have to do that, but we kind of said, look, if we paid $1.60 for this, and for example, that stock is $34. Now, where'd you get the 160? The 160 is the OP, the option premium. Where'd you get the 34? That's the stock price. That's the stock price. 160 divided by 34 is going to give us 4.7%. Wow. So why does that matter? Now, we're going to do this to kind of show this, because I've had some questions on this, and I'm doing this on purpose. So someone said to me one time, well, it doesn't really matter how much you pay for the put. And I said to the person, look, I say this nicely, but you obviously haven't done the strategy before. It does matter how much you pay for the put, because you need the stock to go up by the amount of the put value to break even. The higher the put value, the more the stock has to go up. The more the stock has to go up, the less probable it becomes. Right? So be careful in saying that. Okay? Now, how do you buy the shares? How do you buy the put? Well, I'm going to click on this ask price. Okay? That right there. I'm going to click on it. Once I click on that ask price, it just buys the shares of the stock. Now, it's default to do 100 shares. In our example, we're trying to pick a stock that also where we could buy 100 shares. I think there's a pretty good chance we could buy 100 shares of something here. 100 shares of stock, okay? Now, let me pull this up right on that paper money so we can put that right in. And what I'm going to do is let's pull up AU. There it is. Just like we did before, click on the ask price, okay? Click. There's the 100 shares of stock. Fine. Now, when we pull this back up, how do I buy the put? Do I just come over here to the put right there and click on that? How do I know which one we're going to look at? Why would an investor pick maybe the 34 versus maybe the 33? What delta were we trying to pick again? Well, first question is do not click on that, because if you did, it's going to wipe out the stock position. Once we have the stock position there, we're going to click single order, first triggers SEQ. Click. Once we do that, it's saying first buy the shares first, and then what? Buy the put. Now, when we talk about buying the put, we talk about picking the strike that had a delta between 30 to 40. Now, what you're going to notice is the delta is telling us that the stock goes up or down $1, the first dollar, okay? The option could lose 36 bucks. That's why it's negative delta. Or if the stock went down, it could potentially gain $35. Now, is delta the only thing that's affecting the option premium? No, it's not. Time, volatility, and so on also affect. This is just kind of theoretical price movement. That's a disclosure, okay? Now, if we take a look at this, we're going to click on the 115. In our example, we talked about picking a strike that had a delta between 30 to 40. Why? Well, because we're trying to actually have a right to sell below the current stock price. Now, don't worry, we got a couple examples we need to look at, the past trades. But I'm just lathering you up here to make sure that you can do it. Trust me, I know how to do it. Okay, I don't need practice at it. Now, what I'm going to do is I'm going to pick the 33. Now, you should be able to, in your mind, run through the little math. 34, 28, down to 33. What's the risk per share? $1.28. Is that the total risk? No. Well, you're buying the put too. 115. So now what you actually have is a defined risk of $2.43 per share plus the option commission, if you include that, okay? Now, as you're going to see in just a second, some of our trade examples is we have a right to sell those shares at 33, okay? We're going to talk about when you would want to maybe exercise that or maybe sell that option, okay? So where'd you get the 128 from? Well, it's from 34.27 down to the strike price, okay? Where'd you get the 115 from? It's really the option price. Did you have to buy it at the 115? Could you do it at 110? Oh, you could try it at 110. Okay, there you go. Okay, now I need to know. Okay, just be honest with JB here. Okay, how many of you have practiced these puts? You bought the shares of the stock and you bought the put. How many of you have done at least 2 to 3 of them? Type in the chat. Now, I'm not a judgmental person. Okay, so here's the deal. If you say, I haven't done it, I invite you to practice in the paper money account. If you say, I've done 2 or 3, congratulations, okay? Now, what I'm going to do is going to go confirm and send. And now what you're going to notice, when I said the commission is not on the shares, it's on the option. Now, what we're doing is we're picking a stock position, okay? And then what we're doing is we're buying the put too, just in case, okay? Now, I want to kind of speak to a past example that we did. Now, first thing, what you'll notice is the shares were purchased, and they are right there. What we have yet to get is the protective put down there, okay? Now, when we buy the shares, when we buy the put together, we call that a married put. Married put. Shares plus protection. Now, let's go back to an example, if you don't mind, of something that we've done in the past, so we can kind of get a little bit more comfort on this, okay? So first off, what you're now going to notice is, and finally that one fills, and there we are. So I want to kind of speak to this real quick, and let's kind of start with an example, okay? Let's kind of talk about a new example, past example, okay? If we look at a stock like SPG, Simon Property Group, what you're now going to notice is we bought 100 shares of stock. And that stock was purchased at 183 and it's down to 165. And if we just bought the shares only by itself, well, you'd be down $1,800. Now, you have friends that probably bought shares of something, and in the last month, if you asked them, are you up or down? They would say, James, I'm down. Okay, fine. So that's them, okay? Now, in our example, in the paper money account, let's confirm this, did we buy the put at the same time? Well, what you're going to notice is we added to the position on the 25th to get to 100 shares. And once we had 100 shares at the same time, we bought the put. Now, you're going to see that the put, we bought the put for $2.80, and now it's $14.25. All right. Now, what did we say the rule set was in terms of exiting the position? What did we say we were going to do? Well, go back. We said we're going to wait until the week of expiration. We have 3 days expiration. Second, we wanted to say, is the current stock price above the strike price? The answer is no. Okay, so the stock price is at 165 and the strike is at 180. Now, I'm going to ask you a question here, okay? Very difficult, very difficult. Lock in. Would you rather sell the shares at 180 or would you rather sell the shares at 165? Well, I thought you said that was a hard question. It was if you weren't focusing. Okay, so the investor says wisely, I think I'd like to sell those shares at 180. So this is where they exercise their right to sell those shares at 180. So how do they do that? Well, you can right click on that put itself. And if we go exercise, what does that mean in English? Well, if you bought the put and you exercise your right, when you exercise your right on a bought put, that means you buy the shares of stock. Is that true? That doesn't feel right. It's not right. If you bought the put, you have a right to sell the shares at the strike price. So if we exercise the put, it will sell 100 shares. Now, if you have 100 shares and you sell 100 shares, how many shares would you have? Not a trick question. You won't have a position. The trade is over. Okay? Now, the other way we could do this is we could just right-click on this. Now, notice the put gained in value, 1,145. And so someone might say here, yeah, the put gained, but the stock lost and you're still down 668. Do you understand that the loss is only a third as much as someone who bought the shares only? We bought the shares, we bought the put because we thought the stock was going to go up, but it didn't. So the losses were reduced overall by 2/3. Now remember the question I asked you. If you could cut your losses in half when you have them, if you could cut your losses maybe in 2/3, like in this example, do you think you'd be more profitable? You think you'd be more profitable? So that's a big question, okay? So the biggest actually thing is here, it's not that we're not going to have losses. Here it is, okay? It's just the question is how much is the loss? If we talk about shareholder only, down 1,800. If we talked about shareholder with the protection, down 668. What would you rather have? Now, I know what you're thinking, but I want a gain. I know that, but sometimes we don't always have gains, okay? Now, what we're going to do is we're going to right-click on that option. We're going to create closing order, and we're going to sell, okay? We're going to sell the put. Now, you got to understand something. If we're in the money quite a bit, those options might not be as liquid. You could take a look at the open interest and the volume to double check. We don't want to hurry through this. We want to make sure we could try to get that 14.25, which is the mid price, okay? The gain is on the put. We're going to confirm and send it. Let's see if we can't get filled, or if we can get filled at that. Note the commission as well. Send the order. Now, it just so happened that we got filled. Let's go verify how reasonable that really was. Reasonable, if we had a $14 bid, $14.60 ask, and we had $14.25. We were slightly below the mid or the mark, okay? So maybe. Now, if you take a look at this, what do we have left? We have the shares. Well, right click, create closing order, sell the shares. Because remember what we kind of said is, if the stock is below the strike price of the put, is that a bullish signal or typically a bearish signal? It's usually not a great signal. It probably says the trend is maybe under pressure. Confirm and send. Fire in the hole. Fire. And now what you're going to see is getting rid of SPG. And what you're now going to notice is the investor is saying, I don't want to hold a position that is below a pretty major support level. So the one learning lesson here, let's go back, is if we're in the week of expiration and the stock is below the strike price, the investor A could exercise. I showed you that, which means you're going to it's going to automatically actually sell those shares at the strike price when we click on it, okay, which I showed. Second is we could manually go in and just sell the put. When we sell the put, like we showed, then we could just go in and say, sell the shares of the stock. Now, why didn't we keep the shares of the stock? The stock is still below a significant support level. And if we kind of said, what type of stocks do we want in the portfolio? We have never said, let's hold on to stocks that are below major support levels. We've never said that, okay? And we won't say that today either, okay? So we're trying to have stocks that are above support levels, not below. Now, I want to also go back to a couple stocks that are kind of standing out a little bit, okay? Now, one of them that I want to actually just bring up just quickly is I want to just take a look at, I want to go back and look at a stock, and I just want to pick the one. Yeah, let's go back to just real quick, AIG for just a second, okay? Quick comment on AIG. AIG kind of had a little run to the upside, a little consolidation, and it just kind of went back to the upside. Little consolidation when the moving averages were both red, but really on Friday, okay, Friday, Monday, Tuesday, getting a little bullish action in AIG. Why did you bring that up? Well, because one of the positions that's also in the portfolio, there is a long call on that position. Okay, I want to kind of give you a quick quiz. Okay, so if I said, hey, if the stock goes up $1, okay, approximately, theoretically, what would be the gain if the stock were going to go up $1? Now, remember we kind of said that delta is the change in the option price given, the theoretical change in the option price given a change in this, well, $1 change in the stock price. If the stock goes up $1, the option should go up, or could, by approximately 79 cents. That's the first dollar. Can anyone tell me what the second dollar potentially could be? Well, the gamma is looking at that second dollar movement, up or down. If the stock goes up, that would actually be a higher statistical chance of being in the money. Hence, the delta will become bigger. What would the delta be? Well, you take 78.34, add 269. So that the second dollar move would be about 79 now, plus 273. And that second dollar would be worth potentially about 81.73. Now, if you have a long call and the stock is going up, is having a bigger delta good or bad? Is that a question? Okay. Is that a real question? No, that's good. And so you got to understand is that a long call, if it starts going in the money, meaning higher and higher above the strike price, that long call can act as shares of stock. It's not stock, okay? But the delta almost is acting as if you had 79 shares of stock. And so hallelujah here that we see a little AIG getting a little push to the upside, okay? So we're not going to change anything on that one here, no. Now, I want to go back to also one that's had a little bit of strength, which is that we're going to keep our eyes on, which is RTX, which has been quite strong, okay? That's one we're going to kind of keep our eyes on, a recent crossover. We've also had Triple M that has actually had a little run to the upside, not broken out, but we're going to kind of watch these this week. Triple M and RTX. They're two examples, they're not recommendations, but those are ones we want to see if this week, if we can't get a little bullish push there. Now, I'm going to also stick in that space. We're going to actually go back to a concept that we taught yesterday on GE, okay, which is where we talked about diagonal breakouts. Now, I gave you a specific homework assignment yesterday. I know you did it. You wouldn't have gone to bed without doing your homework assignment. Now, if you take a look at this, we see the high, and then we actually see the lower high, okay? And then what you're now going to notice is we kind of maybe recently had maybe something like that, or we could even say, well, maybe we're getting another high here. So I'm going to kind of draw these lines, kind of connecting some of these spots. Now, something that I want to make sure that we get some practice of this week, for sure, is practicing buying on a buy stop, okay? Now, if we said the angle of resistance is something like this, fine. If I said I get a touch, another touch, and another touch, and what you're now going to notice is I want to practice, okay, doing a buy stop. Now, I'm going to tell you, we trade how we feel. Now, I'll be honest. The older I get, when people ask me, how are you? I tell them it doesn't matter how I feel. It doesn't matter. World's just going to keep going on. I already know what I'm going to do anyway. I'm going to go forward. Don't ask me how I feel. It doesn't matter, okay? The biggest actually thing is when you look at this, in trading or investing, how you feel, does that really matter to the market? Does the market care how James is feeling? I don't think so. Market doesn't know James, okay? Now, if we take a look at this, I want us to practice stocks that could be on the cusp of breaking out of resistance. I want to also go back and practice like buy stops, okay? I'm going to tell you right now, this is something that we need to kind of get practice at. That's why I'm doing it. And in the last 8 or so minutes, I want to practice at least 2 of them. Now, what I'm going to do is, what is today's high? Well, today's high, what you're now going to notice is, if I said, what's today's high? Today's high is at 201.80, okay, 201.80. Now, this is the high of today. Who cares? Well, that investor is actually saying, well, James, I would like to get a certain dollar amount or a percent above that high. All right? Now, when you do like a hold, okay, do you use a dollar amount or a percent? I'm asking you, do you use a dollar amount or a percent? Now, there's not a right or wrong answer. Let's say we actually said, James, in our example, we're going to use a percent. Well, if we said, James, I want to get 1% above today's high. Well, I already know where today's high is. It's going to be 201, okay? 80 times 1.01. Now, 1.01 is just 1% above 201.80, okay? That's all it is. So if you said, I'm not a math person, that's all that 1.01 means. 203.81, okay? Now, I'm telling you, a lot of times when we see reversals in the market, people they don't use order types, okay? So the one thing I want us to flag for sure this week is to practice buy stops or buy stop limits. The limits is what it sounds like. It puts a cap on the entry price. Now, I think of many people say, James, I don't like buy stop because there's no cap on what it could buy for per se. So just so we can all be on the same page, we're going to actually do buy stop limit. So what I'm going to do is on this chart, I'm going to right click on the chart, going to go down to where it says buy custom with OCO bracket. Now, what I'm going to do in this case is once I do that, you're now going to see that it creates an order to buy the shares of the stock. And we already said, where's the price? Well, that price, if I kind of move this around, okay, let's move that so we could see it. We said 203.81. Now, so we can be consistent in practice together. On our examples going forward, we're just going to separate the buy stop price and the buy stop limit $1 apart. Could you make it narrower? Yes. You make it narrower, there's lesser chance to get in. We're going to artificially, always in our examples, $1 higher than the buy stop price. Feel free to change that if you don't like that. GTC. Okay. Now, what I'm going to do is I'm going to go back to the position sizing, 6,500. And if I look at that and say, how many shares could that really be? It's going to be about, what is that? About what, 30 some shares or so? Okay. 30 or so. Let me kind of sync that. Yeah. 31 shares of stock. Now I'm going to round down. Okay. 31 shares. Now, if I looked at this and said, okay, but what about like a stop loss? Okay. Now, remember, if we kind of fell down below this floor here, that wouldn't be great. Okay. We took out that low right there. That's about 190 and a half. 190 and a half less 2 to 3% will go to 186.69. Okay. 186.69. Type it in right there. Now, stop dated GTC, and then this is where we're going to put the target. Okay. Now, when we go back and look at this for just a second, not a bad idea to kind of go look at, let's say, a weekly chart. We know that a shorter term trader might say, James, I'm going to go for the 210, the prior high. But you might also notice on that 3-year weekly on GE itself, this might be really kind of setting up maybe perhaps like an intermediate weeks to month type of flag. And it's kind of pulled back probably about a third of the recent little run up that we actually had. You might set a higher price target. I am going to set the price target at 212. You might say, James, I'm even going to set it up higher than that. I'm going to use this run we actually had from 169 there to there, and I'm going to set a bigger price target, add that distance from 165-ish to 210. That distance was about $45. Add $45 to that low point, 190. That might get us to 235-ish. I'm going to set mine at 212 and kind of just see how strong can we get close? Might we raise the target? We're going to put 212 initially, but we know the higher potential target is right about 235. Now I want to challenge you, okay? When markets pull back and the volatility goes up, so does people's blood pressure. What that actually does is it means they become undisciplined. They don't do the routine because they're trading how they feel. Okay. And so one of the things, the breakdown that happens is when you get markets to pull back, people don't set buy stops as much. People don't do buy stop limits as much because they're fearful. Okay. Notice in our example, we're not fearful. When we talk about buying the stock and setting the stock, buying the put, there's a defined risk. The investor's willing to risk that. If we do this type of trade, we're going back to good old proper position sizing. Are we willing to risk that? The investor is in the business of taking risk. Okay. Now, this is not a downtrending stock. We're going back to kind of like trading the trend above support, proper position sizing, and letting the probabilities play themselves out. Okay. Also remember with the stop orders, there's no guarantee of the execution price, what it fills at. Send the order. Now, I just want to kind of say in closing just real quick, okay? Couple other stocks that we want to keep an eye on this week. Okay, these are examples, not recommendations. Monster Energy is kind of getting a little continuation of that prior high. Moving averages green as well. Keep an eye on that. AMT, American Tower. Also another one, kind of a little income generating potential stock, potential dividend. And you're seeing a little maybe higher low. There's a low, there's a higher low. I'm trying to get a little push. Keep an eye on AT&T, Verizon as well. When you look at AbbVie, which many of you have mentioned, that's been quite strong. You're also going to see that Cardinal Health, last one, is another stock that hasn't even pulled back. It's at the blasted high as well. Okay, so those are some stocks we're going to be watching this week as well. And when I back that chart off, you're going to see that, geez, it didn't really even go down, or if it went down, it went right back up to the prior high. Okay. So some of you have mentioned the stocks in healthcare, and there's a few there in healthcare, along with AbbVie as well. I'm out of my time here today. We did a mixture of really stocks complemented by our protection with buying puts, but we also did the example of just buying shares of stock as well. Now I'm out of my time here today. I want to give us a quick reminder that you could go right to the schwab.coaching page. And you can, for example, if you go to live webcasts and virtual workshops, you can see the next class coming up. And here we are on the 18th. And so what you're now going to notice is here we are for our class. Cameron May will be getting started with options coming up next. Barbara Armstrong in our chat is actually going to be coming up at 2 p.m. Eastern. So that's the schedule for today. Make sure that you actually have that. Now I'm out of my time. Make sure that you subscribe to the Trader Talks channel on YouTube. And also remember, in our examples, they were just that. And remember that scripts are not guaranteed for accuracy or timing. And go out and practice these two things that we talked about here today. And this has been the Investor Master Series on March 18th. I want to wish you a happy Tuesday. Stay tuned for Cameron coming up next. Take care. Bye-bye.